The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Tuesday the 17th, 30 minutes to the close. What do you need to know out of Europe this hour? European leaders pushing back against the coming wave of Afghan refugees. Angela Merkel saying Germany will support the country's neighbours. Emmanuel Macron saying that Europe alone can't assume the consequences. There's been a phone call this afternoon between Boris Johnson, Emmanuel Macron, Angela Merkel and Mario Draghi. We'll see what the response looks like. There could be a G7 meeting to deal with the consequences of the fall of Kabul. Saudi Arabia, the Saudi Arabia of lithium. Let me read that right. The Taliban is now sitting on one of the world's largest sources of rare earths. But with little modern infrastructure, how easy will it be to access that opportunity? We're going to be speaking to a leading geologist to talk about one of the critical things that we all need to think about as we make this EV green transition. And we were just hearing about it. BHP says it will shift its main market listing to Sydney, depriving the FTSE 100 of its second most valuable company. What are the implications of that? Again, we'll discuss it later in the program. Let's look at where markets are right now. We are seeing a little bit of differentiation around Europe. Actually, London is outperforming, and that is lifting the broader European stock 600. We are, though, seeing some weakness in the pound. We have seen some very strong labour market data today, but it's the dollar that is bid, Alex. That's where the trade is.
Yep, that's right. The dollar higher, Bloomberg Dollar Index up by 0.5%. So that's putting pressure on most G10 currencies. 10-year yield pretty much goes nowhere, but there was some stronger buying earlier in the market. But a couple themes happening. One is the weakened retail sales number and disappointing sales numbers out of Home Depot. Home Depot down by about 0.5%, really weighing down the consumer discretionary sector, the third worst performing sector stock along with Lowe's within the S&P. That's that one story. The other part has to do with China. A lot of negative rhetoric coming from investors on China. Paul Marshall, one of them, saying that China is now uninvestable. And this leads me to the Golden Dragon China index. That's the Chinese ADRs that are listed here in the U.S. That's down by 1 percentage point. Not that big of a deal, but overall, we're down something like 30% since the beginning of the third quarter. A real fun reversal there from where we were just 6 months ago, Guy.
Yep. It's amazing to see just how quickly the politics has changed the economics around what is happening with these companies. European stocks are quite geared to that China story more broadly and have been on quite a run recently. Bloomberg TV speaking to a number of market watchers on how they're thinking about how much longevity there is left in this trade.
The earnings revisions have been super positive. The first and second quarter earnings seasons were very good. So in fact, valuations have come down.
It is hated. But the fact is we have incredibly strong corporate earnings.
My view is that we have seen sort of all-time highs in European equities, but it's been accompanied by upgrades to earnings expectations for this year and also for next year.
The fundamentals are there.
The earnings revisions have been super positive. The first and second quarter earnings seasons were very good. So in fact, valuations have come down.
I expect equity markets to do very well again for the remainder of the year and next year also.
I think the best bang for your buck, probably in these value areas that people all hate. So banks, energy, mining companies, the things that investors have really been
So
unsure
the E has been outpacing the P, i.e. the valuation still looks relatively reasonable, or does it? Or is it time to start rethinking this European trade after such a strong run? Let's get another thought on this matter. Patrick Armstrong, he's the CIO of Plurimi Wealth Management. Patrick, always a pleasure to speak with you. What do you make of where we are now? We are seeing potentially the first down week in a very long time for European equities. It is August. There is always going to be maybe a little bit of volatility. But maybe this is an opportunity to rethink that trade as we head into the fall. What are your thoughts?
Yeah, I think the market's in the midst of a bit of a growth scare. It's not a panic about growth, but the market is worried about growth. You've seen China numbers a little bit weaker than expected, U.S. retail sales a little bit weaker than expected. My view is the fourth quarter is going to be very strong. It's going to be a continued reopening. The Delta variant's a risk, but I think we've seen pretty clearly now that countries and regions of countries that have high vaccination rates, you're getting a good level of efficacy from that, and that's basically meaning you don't have to shut down. Economies can reopen. You've got ample savings that have been built up during lockdowns. That's going to be spending power, and you're going to get fiscal thrust from new infrastructure spending. So I think the economy is probably going to surprise to the upside a little bit, and companies are priced that earnings are going to fall off a cliff. Maersk is trading at 4 times earnings because everyone's convinced logistics companies' earnings are going to disappear. ArcelorMittal is trading at probably 5 times earnings as well. Everyone thinks the infrastructure spend and growth is going to die out. So if you have any belief that growth continues even for a little bit longer, these companies are incredibly attractive.
I mean, but the Stock 600 technology index is at a premium right now to the NASDAQ. So does that just imply that the value is just in the cyclicals, that misprice is more in the cyclicals than in the technology names? If so, do you have to rethink how you're positioned in technology in Europe?
Yeah, if you want technology, Europe's not my first port of call. We love ASML. It's a beneficiary of what's happening in the shortages in chips, and chip manufacturers need equipment from ASML. So that's one we're happy to pay a bit of a premium for. But the attraction of Europe for me is the cyclical companies that are just trading at very attractive multiples. So I think if you want tech, there probably are. You're better off in the United States. I think those companies aren't incredibly valued, but they're incredible companies. So you pay up for them and you get what you get. It's the cyclical growth that I'm really attracted to in Europe.
Patrick, how much longer does this go on for then?
I think there's 3 pillars supporting equity growth, and while all 3 of them remain in place, equities grind higher. So while real yields are negative, while there's abundant, massive liquidity in place, and while there's economics growth that's leading to earnings growth, those 3 things, if they remain in place, it's hard to see why people will be selling equities. So you're punished if you hold cash, you're punished if you hold bonds, central banks and governments supporting the growth. I think it continues well throughout the fourth quarter anyway, and there are just companies that are priced that earnings will disappear. I just don't think that'll happen. I think we're in a reflationary backdrop for much longer than what the consensus view is.
So what does that mean for financials, for example?
Financials, I like them in the United States more so than Europe. Financials have been a value trap that have caught me a number of times in the past in Europe, so I'm a little bit more skeptical about the steepening of the yield curve. But I think we, at Jackson Hole, we get the announcement that they're going to discuss tapering on September 20th, and I think there'll be a formal announcement of tapering in the United States that'll happen in Q4. That'll lead to a steepening of the yield curve in the United States, and I think that's very supportive for financials in the US. So banks look very cheap in Europe, but I like the steepening curve in the United States that attracts me over to that side.
Patrick, one of the key metrics that equity investors look for from a macro perspective is what is happening with PMIs. I find it hard to believe that PMIs aren't going to slow from their recent record highs. These are diffusion indexes, they're month-on-month reflections of what is really happening. As we start to see the effect of that, does that change the dynamic here in Europe as to what you want to own?
I think they're not going to slow as much as people worry. I think because you are comparing from very high bases to what in the summer you were comparing to very low bases, that is a drag on PMI. I think the services is going to continue to show an acceleration just because economies still aren't completely open yet. And I think there will be incrementally more reopening and the services will really benefit from that. But I think what's happening in the United States is the fiscal thrust that's going to happen. I think that drives a wave up in the economy globally. And PMIs are something you always have to look at. It links very closely with European GDP, but I actually think they'll probably be surprising to the upside in the fourth quarter.
So does that mean that you expect China, for example, to be able to fix any kind of slowing issue that it has? Because if it can't, that would imply that those kind of value cyclicals that you're talking about, et cetera, will come under pressure. So what's your view on China?
So China, it's growing and slowing, but it's still growing very robustly. So we're talking about 7% GDP growth in the United States almost this year. China's going to be around that, but it's slowing down to the 6s in the next year. It's still strong growth. It's still demanding commodities. It's still manufacturing. All of those things still in place. Maybe not running quite as hot as maybe some of the optimistic forecasts were a few months ago. It definitely has slowed. China's put in policies and regulations and credit policies that have been designed even to slow that growth. So it's not just happening by accident. I think there still is strong growth in China. I'm not investing in China because of the policies, but I think as a driver for the world, it's still boosting world growth.
All right, Patrick, good stuff. Really appreciate it. Thank you very much. Patrick Armstrong, Plurimi Wealth CIO. Want to update you on those Taliban headlines that are crossing. This is the first press conference after Afghan fell. As of now, the Taliban is saying that we have liberated the nation from the occupation, but they're giving some assurances that all media will be free and independent. They also call on all nations to help develop economy and trade. They also vow to not discriminate against women, and they have the right to act on the basis of religious principles. I don't know how you square those last two. They might not actually wind up fitting together, but also, Guy, interesting that plea to help develop the economy and trade, of which there is so much potential.
There is. It's a very low base. I think what the fear is that is not going to be enough to keep people in Afghanistan. The fear is that we get a massive wave of refugees. That's certainly the fear here in Europe. That's why we're having a series of conversations between European leaders right now. They don't want to repeat what has happened in the past. Angela Merkel leaning very heavily on the idea that we should see local or regional countries doing the heavy lifting in terms of dealing with those refugees. There has been a call, we now understand, between Boris Johnson and the Pakistani Prime Minister, Imran Khan, on Afghanistan and what is going to happen. We're going to be talking more about that in a moment, because the big fear, obviously, is that while Pakistan in some ways has held this kind of dual-track strategy over the last few years in terms of, on one hand, being a supporter of the US position, but also maintaining very strong connections with the Taliban, whether or not ultimately they do have to bear the burden of the refugees. It's going to be an issue for Pakistan, I think.
Yep, and we're going to talk just about that with Shamila Khan, AllianceBernstein Director of Emerging Market Debt, will be joining us on just that issue. This is Bloomberg.
In time, Afghanistan will also need its own manpower, and Europe alone cannot assume the consequences of the current situation. We have to anticipate this and protect ourselves against significant irregular flows of migration. That would endanger the people who use them and feed all sorts of human trafficking.
Now, as French President Emmanuel Macron speaking on migration from Afghanistan. Now, the Taliban is holding its first press conference since the fall of Afghanistan, saying that they've, quote, liberated the nation from the occupation. For more on this and Europe's response is Bloomberg's Ben Stills, who joins us live from Madrid. Ben, what are we learning? Give us the latest from what we know is happening on the ground.
Well, in terms of the European response, this comes at a really sensitive moment for the Europeans. The Germans are preparing for an election next month, which is going to be the first election without Angela Merkel as a candidate for, well, as long as I can remember anyway. And then next May, or April, May, in the spring of next year, is the French election where Emmanuel Macron, who you heard from just then, is going to be defending the presidency against his would-be nemesis, Marine Le Pen, who's a kind of classic anti-immigration nationalist in the European mold. So the idea that the crisis in Afghanistan might start triggering flows of refugees heading towards Europe once again sends really kind of chills of fear through the political establishment in Europe. The last German election in 2017 was overshadowed by the refugee crisis that we suffered a couple of years before that. And the establishment politicians know that if they start having to deal with those sorts of pressures, it's going to be a real gift to the likes of the AfD in Germany and Le Pen in France, who are looking to make political capital.
And I guess that's why Angela Merkel talking last night about the idea that regional neighbours of Afghanistan should be the first port of call. Bloomberg's Ben Stills, thank you very much indeed. Let's carry on that element of this conversation, the impacts on the neighbouring countries. The IMF's financial support for Pakistan will give the nation's dollar bonds some protection against the spillover effects caused by the crisis in Afghanistan. We still don't know ultimately what the numbers are going to look like. Shamila Khan, joining us now, AllianceBernstein Emerging Markets Debt Director. How unstable do you think the situation is? I saw a reaction yesterday in Pakistani bonds. It wasn't a substantial one. Is there a belief ultimately that even if Pakistan does have to do the heavy lifting here in terms of refugees, it will be supported by the rest of the world?
That is the belief. And that is why the impact on Pakistani bonds were quite muted. Look, there are going to be refugees. There's going to be uncertainty related to the situation. However, we do believe that Pakistan's geopolitical importance will increase. Now, in terms of what has happened, I believe that even the Taliban are surprised about how easily they were able to take over the country. And it is becoming apparent from their statements and the press conference that they are, at this point, focused on consolidating their power within the country and stabilizing the situation and allowing the country to resume normal operations. That is their priority right now. Their geopolitical ambitions, as well as the ideology they will follow in the country, will only become apparent in the medium term. And that is when the world will need countries like Pakistan to negotiate with them.
So in that interpretation, it makes Pakistan more important, like you said. On the flip side, I wonder if Pakistan winds up working with the Taliban, are we going to wind up seeing sanctions, Western sanctions being put on the country, sort of putting their financial strain under stress? Like, it feels like it's in some ways a binary scenario for Pakistan. They become more important or they become wrapped in.
I don't think the Pakistani government is under any illusion about their level of external vulnerability. I think they understand that they do not have room to make mistakes like that and have to deal with US sanctions. I don't think they will go down that path.
In terms of the role that China is going to play here, how important is it going to be? Pakistan represents a significant element of the Belt and Road Initiative. They don't want to see it becoming a struggle, and they don't want to see it being overrun by refugees. How are they going to counterbalance what is happening on the ground?
Absolutely, and that is part of what I am talking about. These countries will do what they need to make sure that Pakistan remains sustainable. They will continue to give financial support. It's going to come not only from China, but from other countries that are vested to make sure that Pakistan remains a stable country. We certainly do not want more instability in the region. And that is one of the reasons I believe that Pakistan has now become even more geopolitically important.
So does that mean that those bonds make a good investment right now, Shamalia?
I believe that Pakistani bonds were not reflecting the risks prior to what has happened. As they cheapen up, they are starting to reflect that risk and therefore are becoming more attractive.
In terms of the history, is there anything we can lean on? I was trying to look back and get an understanding of kind of how Pakistani bonds have performed in the past. And they've been remarkably immune to geopolitical tensions that have affected the region. Why is that?
Because the government is generally quite pragmatic in this sense, right? They will not allow things to happen which could cause sanctions to be imposed on them. I mean, obviously, this is not the only border issue they have. They have had issues with India. Things have gone to the brink, but they've always come back. And that is what has caused those bonds to actually trade in a far more stable way than the geopolitics could imply.
Shamalia, where do we need to see the risk reflected in the market? We talked about how there was a muted response to the Pakistani bonds. We kind of have an idea of why that is. We don't think there's going to be any sort of sanction push against Pakistan. Where should the risk be reflected anywhere within the debt market for emerging markets?
Yeah, Alex, that's a really good question. And the reality is that in the very near term, I don't think the impact's going to be big because I do believe the Taliban are going to do what they're saying, which is focus on consolidating control within the country and not try to rock the boat. It is really the medium term. And unfortunately, you know that markets don't ever price in the medium term where the risk may start emerging. And the risk is going to depend on how strongly the international community can engage with the Taliban to make sure that the human rights situation in the country, their ability to harbor terrorists are curbed because of either penalties or incentives they can give to the government. And that's when we will understand what the implications for the market will be.
All right, Shamaya, thanks a lot. We're going to have you back to talk about it. Shamaya Khan, AllianceBernstein Emerging Market Debt Director, thank you very much. This is Bloomberg.
From London, I'm Guy Johnson, Alex Still in New York. This is the European Close on Bloomberg Markets. Alex, we're getting some data in terms of the numbers coming out relating to COVID from the UK. The mortality number, the death rate, has crept up quite significantly. You do get some statistical issues surrounding the weekend. These are Tuesday data, but I think the problem is that it relates back to Monday. And the number is quite high, 170 more COVID deaths on August the 17th. 26,852 more COVID cases. That number is where we're getting some stability. That number is kind of, it's jumping around a little bit, but you are getting some stability. But the modelers are saying that it could tick up over the next few weeks, and you could still find yourself in a situation where you are dealing with circa 100,000 cases a day. In terms of the news we've had today relating to vaccines, the UK regulator has approved Moderna's vaccine for 12 to 17-year-olds. We've started vaccinating 16 and 17-year-olds. That has been cleared. It's obviously now going to push down through the cohorts. It'll be interesting to see how far it gets sort of between now and Christmas as schools go back.
Yep, and similar, this is the second vaccine because Pfizer's already approved, but they're only offering the shots for those 16 and up, anyone who's really vulnerable from 12 to 15. It's a different approach from what, say, the U.S. is taking in terms of vaccinating children, where the UK, I feel like, has been much more reticent to commit to vaccinating, to having more of a mandate for the kids.
Yeah, I think the risk goes, as you get younger, the risk increases because the effect of COVID on that cohort is becoming incrementally less and less. Most of them are sort of asymptomatic. I do think it's interesting what is happening in the States, though. This focus on the third round, I suspect that is very much aimed at areas that are highly vaccinated, because you could argue actually the focus should be on getting everybody vaccinated. Many still aren't. Yep, except, here in New York, at least, if you are eligible for that booster, you're not going to get it before September, but it's coming. It's definitely coming. Yeah, like September's not that far away. Anyway, European markets are looking a little bit like this. I know, summer's nearly over. European markets are looking like this. FTSE being boosted by the miners, BHP. We'll talk more about that in a moment. Plus, we're going to talk about Afghanistan from a mining point of view. Rare earths. That story as well coming up. So we're wrapping up the Tuesday equity session here in Europe, shutting down the markets. It's a mixed map. It's not the world's most exciting map, but actually I think it's showing you quite something significant. What you've got is peripheral markets under a little bit more pressure. The Italian market's down by 0.8%. The IBEX down in Madrid down by 0.6%. Core markets, the UK, the CAC, the DAX, the Swiss market, a little bit more muted, though Switzerland getting a little bit more traction. But what you're seeing here is a buy the dip. The DAX got absolutely smacked first thing this morning. It's now recovered. It's coming back. The buy the dip mentality is alive and well, it seems. It doesn't look that exciting, but it is still quite significant. Incrementally, this stuff matters. So let me kind of move on, and I'll show you what is happening with the Stock 600 and the chart. You can see it. There's the gap first thing this morning. Down to where we were there, and we've just climbed incrementally back throughout the session. We're not up by much. We're up less than 0.1%, but nevertheless, the dip has been bought. That is quite significant. In terms of what's been moving around in other asset classes, let me just highlight a few things because they are significant. The dollar is very much on the front foot. There's the cable raise. Despite some really strong labour market data today, you did see the pound falling by 0.8%. Crude is bid. It's back. We've got it up by 0.6%. Copper is, though, still down, which is quite significant, which is worth bearing in mind. Look at what is coming out of China. I think there's probably some reasons for that. Copper's been under a little bit of pressure. But that then translates, this narrative then translates into what we've seen in terms of the FTSE, the DAX, and the CAC. So here we go. FTSE 100 up by 0.3%. It's the miners that are leading that narrative. BHP Billiton, certainly a big part of that, despite the fact it is going to be exiting stage left from the FTSE 100. The DAX is flat. It's come back up a little bit. The CAC 40 is still negative, 0.2%. But broadly, in aggregate, people have been buying the dip, Stock 600. There's some differentiation in terms of the individual markets. And there's been some real heavy lifting being done by individual stocks. Let's take a look at the Stock 600. You can see a more defensive bias to the market today. Healthcare is bid. You've got some of the staples. The energy sector's come back. Food and beverage coming back. Bottom end of the market, this is why Germany's underperforming a little bit. The car sector, the banks have been on offer really since first thing this morning, down by 1.2%. Nevertheless, feels a little bit more stable. In terms of the equities, Pandora catching a really decent bid. There's a number of different questions around this jewelry company which are worth bearing in mind. The US looks really strong. I thought today's retail number was quite interesting. So they've really kind of lent heavily on strength coming out of the United States. But maybe that narrative will start to sort of fade off. We're certainly seeing evidence from US retailers that may be the case. Does that continue? Nevertheless, the outperformance is there. Does Europe pick up when the United States starts to fade, if it does? Just Eat up by 2.85%. The delivery business at the moment hot with speculation around consolidation. But actually, they've had to expand very quickly. That expansion has cost a lot of money. The indication coming through from the company today is that that kind of spending may be starting to peak. You're getting a decent response to that, up by nearly 3%. And then we come to BHP. It's leaving us. But nevertheless, today, delivering some really strong numbers, a reorganization of a company, and the market is also just arbitraging a little bit that opportunity. As we lose the London listing here, it's a 1-for-1 swap into the Sydney listing, and there's a little bit of upside on that, and that's being reflected in the share price as well today, Alex.
Yeah, Guy, that's quite interesting because if you might like the company just fine, but if you wind up having to buy the FTSE 100, you now can't buy it. So that's posed a little bit of a difficulty for some shareholders. Earlier in the program, we spoke to the BHP CEO, Mike Henry, about how he feels about these investors, and here's what he had to say about scrapping that dual listing.
I think that shareholders overall are going to see this as being a really positive move for shareholders overall. And they'll understand why the company is doing this, and that's to set the company up for the future. It's going to make us more efficient and more agile, and of course that agility matters in today's world.
This strikes me though, Guy, because it feels like this is a really tough moment for that to happen for the UK. That's trying to attract more listings, not lose listings.
Well, in some ways, yes, and in some ways, no. Let me kind of take the no side of it. There are many that argue that the FTSE 100 is old school. It doesn't have enough tech. It doesn't have companies that are growing, growth stocks that the US has become so famous for. It is heavy with energy stocks. It is heavy with miners. It's your perfect index.
It is.
But nevertheless, maybe there is an opportunity here, maybe to give others the opportunity to have the spotlight shone upon them and have the halo effect of being in the FTSE 100. That could certainly be a positive maybe in the long run, but certainly it's going to hurt in the short term.
Yeah, it's not a bad point, honestly. That's sort of like the upside to that in terms of trying to transform what the index looks like. Let's stay with some raw materials for a second. So when it comes to Afghanistan, the country has a lot of reserves of lithium, copper, rare earth minerals, and dozens of other minerals, part of what BHP also has. So what's going to happen to those resources under Taliban rule, and how will this impact the overall space? Well, joining us now is Rod Schoonover, head of the Ecological Security Program at the Council on Strategic Risks. Rod, first just walk us through kind of what's there in Afghanistan and how much is there?
Right. So thank you. As you mentioned, lithium, copper, talc, cobalt, dozens of other minerals and gemstones, and some estimates point to about 1.4 million tons of rare earth elements such as lanthanum and cerium, neodymium, and these are the minerals critical for high-tech electronics, green tech, smartphones, hard drives, aerospace, and defense technologies. And worth is a difficult parameter to gauge because of the difference between utilization and potential, but some estimates of around $1 trillion US dollars sounds about right.
It's interesting. The Taliban is currently giving a press conference saying they're not going to produce any more opium. Maybe they're going to focus on mining. In order to do so, how easy would it be? What is the current state? How easy is it to mine this stuff? Just even from a geological point of view, is it easy to get out? And then you've got to deal with kind of roads and rail and all the other kit that you need.
Right. Now, it really depends on which minerals we're talking about. But because of the geology of Afghanistan, Some of these deposits are remarkably accessible, especially the rare earth elements. But that's just the geological point of this. Afghanistan is very underdeveloped, not only because of, with respect to mining, but also, as you mentioned, the infrastructure. You need roads, you need rail, you need energy, you need water, and you need security. And all of these things will make a transition to a mining-based economy very difficult. And that's not to even mention, you need a trained workforce, which has presumably been gutted over the last decade.
So, Rod, let's just pretend for a second that the Taliban had a blank checkbook. How much money do you think would need to be put into it to develop, and I'll just say lithium just for argument's sake. And if it is developed, how quickly can it sort of get to market? What's the time frame are we talking about?
Again, that's a difficult question, but because it's more than just a pocketbook, it's also a stable country. But just in terms of a time frame, we're probably talking about decades rather than years. And it's a lot of money. It takes, even in stable countries, it takes a considerable amount of time to go from mineral discovery to exploitation. And so these are difficult things to do. You know, I think minerals will have a future in Afghanistan, but I think you know, as I mentioned before, a trained workforce and benefits to the people, I think it's a big question mark.
A lot of people, when they think about rare earths, think about China. How does what Afghanistan has compare to what China has?
So the issue with China is that it has developed and processed rare earth minerals, and so, which is a hazardous thing to do. The United States used to do it to a very large degree, but the ecological issues were pretty pronounced. So in terms of potential, I'm not sure we really know until you get a lot of geologists on the ground, but it's likely to be in the top 5 worldwide, maybe even higher than that.
What are the chances that China can become to Afghanistan as it was to certain parts of South Africa and other parts of the Middle East in terms of pumping in billions to support natural resources so they can kind of get it on their own? What are the chances of something like that happening?
That's a terrific question. I think the interest in lithium and rare earth minerals are definitely there in Chinese strategic planning. I think it's an open question to see how much interest in Afghanistan broadly the Chinese really have, considering Afghanistan's security and stability challenges. You're taking on a lot, not just the infrastructure needed to process and move minerals, but you're also you're bringing being asked to deal with security as well. It's not clear to me that Chinese have that appetite. I think it's an open question. It's an interesting question.
Yeah, it's amazing. We've just seen the takeover of Kabul, and this is what we're thinking about. But the world is moving on, and the world is going to need this stuff if we are going to make the pivot that we need to do in terms of the climate. Rod, thank you very much indeed for your time. Rod Schoonover of the Council on Strategic Risks. Thank you very much indeed. We're wrapping up the session here in Europe. The markets have settled. These are the final numbers. As you can see, a little bit of outperformance coming through from the FTSE 100, driven in large part by BHP, which, as we now know, is going to be exiting. The car sector under a little bit of pressure, but the DAX coming up to flat as we finish the session. The buy the dip story still not that far away. The CAC 40 down by 0.3%, Alex.
All right, maybe we'll get some clarity on that in the next couple hours, because coming up, we are awaiting Powell, the Fed chair, appearing at a town hall event amid rising taper talk. Michelle Meyer, BofA Research, a global research head of U.S. economics, is going to be joining us next. This is Bloomberg.
This is Bloomberg Markets, the European close. I'm Rishka Gupta, and you're looking at a live shot of the principal room. Coming up, Rebecca Pringle, the National Education Association president. That's at 1 p.m. in New York, 6 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Rishka Gupta. In Afghanistan, the situation at the Kabul airport appeared to have calmed down a little after yesterday's chaos. That's when hordes of Afghans desperate to flee tried to crowd onto planes. Today, the Taliban have sealed off the airport and are only letting members of the international community through. Civilian and military flights have resumed. In California, wildfires have now burned more than a record 1 million acres this year. Crews are battling 10 large blazes, including the Dixie Fire, the state's second largest ever. That fire has destroyed more than 1,000 buildings. The U.S. government is preparing to offer coronavirus booster shots as soon as next month. Biden administration officials are expected to recommend the shots be taken 8 months after people receive their second vaccine dose. The U.S. is facing a renewed wave of infections fueled by the Delta variant. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Alex?
All right, thanks so much, Ritika. The main event today, Fed Chair Jay Powell will be speaking at a town hall on education this afternoon. And joining us now for a preview, Michelle Meyer, Bank of America Global Research Head of U.S. Economics. Hey, Michelle, substantial further progress. Are we going to have any clarity as to what that means today from Powell?
Well, I think it'll be very similar to how he's explained in the past, which is that the Fed needs to believe that they are well on their way to ensuring they reach maximum employment, where they have broad-based improvement in the labor market, employment to population ratio recovers, and they have a sufficient healing in the economy, which can guarantee that they continue to see at or slightly above target inflation. So I think he's going to be very descriptive in his commentary. This is a conversation in front of educators. It's supposed to be one where he really takes a look at what the Fed is trying to achieve and what their framework looks like. But I don't anticipate that he's going to give much in the way of new guidance around when the taper might begin or what it might look like.
Michelle, what's the relationship between QE and the labour market right now? We seem to be shifting to a more services-based labour market recovery. The services side of the economy relies less on low interest rates compared to the industrial side of the economy.
Yeah, I mean, look, there's always that question of how do you actually think about the relationship of balance sheet expansion or QE and the real economy. And presumably that transmission is through lower interest rates, because part of the way QE works is through forward guidance. While the Fed is actively expanding their balance sheet, then it reinforces the idea that the Fed is committed to a low rate environment for the foreseeable future. Once the Fed starts to scale back, market participants naturally can start to price in potentially higher interest rates. So,
but Michelle, that's fine.
Yeah.
That's fine. But the services side of the economy doesn't need low interest rates. It's much less sensitive to low interest rates than the industrial side is.
Yeah, of course. But again, it's this idea that there's a low cost of capital. Consumers can go out there and take on debt if they want with a low interest rate. They can feel comfortable and confident about the cost of borrowing. And even companies that are more on the services side, also when they think about their debt or their financing, they can have potentially lower costs. So yes, goods presumably is more sensitive. There's a lot more fixed capital that they're investing in than on the services side. But it's really all about this forward guidance that QE holds. But can QE fix the services side of the economy? Can they get people back out traveling again in the face of the Delta variant? No, obviously it doesn't have that type of power.
So talking about power, retail sales, what did you make of the number today? How do you expect that sort of colors or sort of clouds Jay Powell today?
I think the Fed is very concerned about some of the signs that they're seeing in the data flow around a potential soft patch in the economy. And I think that there's good reason to be. A lot of the high frequency data that we track shows this kind of softening in the services side of the economy, which had been ramping up at a powerful pace up until the last 4 to 5 weeks. And retail sales today, while it's not capturing services, it's more capturing goods, it shows there's a bit of pullback in goods. And then I think that will be even more clear cut when they get the services data, that people also start to pull back their willingness to spend on certain types of services like air travel in the face of the pandemic. Look at University of Michigan Consumer Sentiment Survey on Friday. People are clearly concerned and they're paying attention to these risks. So I think for Chair Powell, they need to see more data. They need to see how this ends up playing out for the real economy. And particularly extremely important will be the jobs report for the month of August, which we don't get to the first week of September. So until then, I think the course of action will be to kind of talk about the preparation for tapering, but not finalize any real timeline at the moment.
Given that ambiguity, can Fed communication be good enough to avoid a tantrum?
Well, it has been so far. One thing that Fed officials have been very clear on, Powell has, reinforced this idea, is that they, were very, very sensitive to the 2013 episode where taper somehow surprised markets. And what they have done this time around is taken really baby steps to the eventual taper to make sure that when they go ahead and actually execute the change the balance sheet policy, it won't come as a surprise to the markets, that it'll be well priced in. Now, the challenge with doing that and pricing it in, kind of in advance and making sure that markets understand, is that you kind of start to see some, reaction just off of these small steps towards the taper as markets prepare for it. So in a sense, you can kind of tighten financial conditions a little bit before maybe you would like to, all else equal. But I think, the idea that the markets are going to tantrum once the taper actually begins, that to me is a very low probability event, given how the Fed has communicated thus far.
Great stuff, Michelle. Always a pleasure. Thank you very much indeed. Michelle Meyer, Bank of America Global Research Head of U.S. Economics. Powell tonight, minutes tomorrow. That's obviously the big story that we're going to be focusing on. We'll detail what the rest of the week looks like next. This is Bloomberg.
Live from New York, I'm Alex Deal, Guy Johnson over in London. This is the European close on Bloomberg Markets. So a lot coming up next 24 hours. Aside from Fed Chair Jay Powell at 1:30 p.m. Eastern, we're also going to hear from Minneapolis Fed President Neil Kashkari hosting a town hall as well. EU foreign ministers will also be having an emergency meeting about Afghanistan. Guy, we've heard that there's been conversation between them, like Boris Johnson and Emmanuel Macron earlier in the day as well.
Yeah, the leaders are clearly worried about what is happening here. The fear in Europe, particularly ahead of elections, is that we get another huge wave of migrants. That certainly interrupted the German election last time round. Angela Merkel keen to make sure that doesn't happen again. Same goes for Emmanuel Macron. Tomorrow, we move from Powell to the Fed minutes. You wonder whether Powell's going to be dovish, whether the minutes are a bit more hawkish. Certainly, we're trying to get a schedule, some sort of sequencing in terms of how this taper is going to happen. We're going to hear from Dallas Fed President. Mr. Kaplan is going to be speaking. We're going to get data, inflation data out of the UK. We're also going to get it out of the Eurozone. Then we get to the earnings. Now, the retail theme continues. We also get 10-cent numbers. Lowe's and Victoria's Secret is out. Target's out as well. Nvidia's out as well, which I think is going to be really interesting, Alex, in terms of the narrative surrounding the availability of chips.
Yeah, Nvidia also one of the lower performing sectors on the S&P today. Also, there's the issues with its takeover of a UK chip company as well. There's a bidding process going on right now. We'll see where that leaves us.
Yep.
And also Target. So my favorite thing in Massachusetts is to go shop in Target, basically, because it gives me and my daughter something to do. But sales estimates for comps are coming in about over 8%. After Home Depot's miss, it'll be interesting to see where Target comes out, because they did well in the pandemic, but you could also argue on reopening they could also do well. So kind of where they straddle in this quarter.
What I was surprised about, if you take a look at today's numbers, what really surprised me out of the US retailers was A, that we're not getting a better performance on the e-commerce side of things out of Walmart, which I thought was really surprising. And then as I came in this morning, I was looking at the relative share prices performance to see what's going on. The underperformance of Walmart this year is absolutely staggering. So you're getting huge dispersion within some of these US retailers, which I think is fascinating.
And really tough comps at the end of the day, too. All right, well, that wraps up for me and Guy on television. Coming up, Kay Bailey Hutchison, a former U.S. ambassador to NATO, will be joining Balance of Power with David Weston on Bloomberg Television and Radio. And Guy and I are headed over to radio also for Bloomberg's The Cable and DAB digital radio, so tune in for that. This is Bloomberg.